In this video, we will discuss raising capital. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently a chair of accounting and financial management for the Graduate School of the University of Maryland, University College. The sources of a company's funds depend on many issues. Might be stability of earnings, growth rates, investment opportunities, tax rates, and many other issues. Companies go through a lot of different stages. They might be a new company, financed with venture capital. They might undergo a public stock offering as a new company transitions to a more stable company. They might be funded with things other than stock, such as preferred stock, investment-grade bonds, junk bonds, or just bank loans. The mechanisms of a company's finances and their abilities to raise capital are heavily regulated by the Securities and Exchange Commission. For example, in most cases, only qualified investors are allowed to invest in non-public companies. We will discuss what a qualified investor is later in this presentation. Startups are commonly funded by angel investors. This is particularly common now in Silicon Valley. These are generally wealthy individuals who finance firms with their own capital. They commonly sit on the board of directors of the startup firms and give them advice on how to manage them. Well-known investors in the tech industry include Marc Andreessen, another University of Illinois alum, Peter Thiel, Fred Wilson, Naval Ravikant, Chris Sacca, and Scott Bannister, who I had the pleasure of knowing while I was at the University of Illinois. Private equity is capital that's not listed on public exchange and therefore not as heavily regulated by the SEC. It's composed of funds which investors directly invest in privately held companies, and again, only accredited investors may invest in private equity. A qualified or accredited investor, as determined under the SEC's Rule 501 of Regulation D, would be an individual that has an income of $200,000 a year or a net worth in excess of $1 million separate from their house. The idea is that wealthy individuals are in theory more knowledgeable and more qualified to make investment decisions than private individuals with less wealth. Presumably, the government believes this is a mechanism of protecting non-knowledgeable people. This is questionable considering most of the people that started firms in Silicon Valley today started out as not terribly wealthy individuals. Similar rules apply to qualified institutional buyers, and that's a corporation that invests a minimum of $100 million in securities on a discretionary basis. Threshold for an accredited broker-dealer is $10 million in investable assets. An example of a venture capital fund would be the Founders Fund. It has financed companies including Airbnb, Facebook, Lyft, Palantir, and SpaceX, and is headed by Peter Thiel, formerly of PayPal, and one of the initial investors in Facebook. Includes this long list of partners, including my friend Scott's wife, Cyan Bannister, and until recently, Luke Nozick, also from the University of Illinois. They manage around $3 billion in capital as of 2016, investing in startup funds, and they typically invest at least 20% of the partners' own money in the startups and then other money from other investors. Since they have so-called skin in the game, this gives them a strong incentive to invest in companies they think will do well, and the partners are also involved in advising the companies that they invest in. After a company is operated privately for a few years, it is typical for it to undergo an initial public offering or an IPO, transitioning from generally a relatively small privately owned firm to a larger publicly owned firm. They raise a lot of capital this way for expansion, and also it's a way of the initial investors to recoup some of their investments. The initial public offering process is very heavily regulated by the Securities and Exchange Commission. It would typically involve an underwriting team of certified public accountants, lawyers, CFAs, CFPs, etc. And the financial statements undergo an official audit. There are rules as far as filing the prospectus with the SEC, various dates to do road shows to advertise it, etc., etc. The underwriting contracts can be handled in several different ways. You can have a firm commitment contract where the underwriter guarantees the sale of the issued stock at an agreed upon price, a best efforts contract in which the contract underwriter agrees to sell as many shares as possible at an agreed upon price, an all or none contract where the underwriter agrees either to sell the entire offering or to cancel the contract, and a standby contract where the underwriter agrees to buy all of the shares that the issue is not able to sell. At various times in the past, companies have also been heavily financed with junk bonds. Today, most junk bonds are fallen angels. Junk bonds come in basically two types, fallen angels and new startups. A fallen angel would be a company that at one point in the past was stable and doing well and has gradually fallen on hard times, and their bonds have been gradually downgraded. During times in the past when the stock market was not as heavily valued as today, a lot of startups were actually financed with junk bonds. CNN, MCI, and Sprint all received some junk bond financing. Today, P/D ratios on stocks are very high. It's typical for companies to go public, whereas in the late 70s, the stock market was not valued very highly. P/D ratios in the S&P could be as low as 7 or 8. And many companies decided junk bond financing was a better way to go. During this same time period, leveraged buyouts were far more common. During the 1970s and early 80s, again at that point in time, the price-earnings ratio on the S&P was below 7. Today it's in the 20s. At the top of the dot-com peak, the P/D ratio on the S&P hit about 30. During this time period, investors such as Michael Milken would use junk bonds to buy and restructure companies, making them more efficient. Typically, Milken and Company would buy a company. They would fire a lot of the top management. They would get rid of the fleets of corporate jets and limos, etc., turn the companies into more, financially efficient companies, and then take them public again. There are different opinions on Michael Milken. For a positive opinion, you could read Daniel Fischel's Payback, The Conspiracy to Destroy Michael Milken and His Financial Revolution, or Stewart's Den of Thieves, which is far more negative on Michael Milken. Here is a list, again, of trailing earnings on the S&P 500. You can see that during the dot-com bubble, the trailing earnings got up to ridiculously high rates of 130. Now they're down in the 20s, and again in the 70s, when junk bonds and leveraged buyouts were popular, we had numbers down around 5, 6, 7. Similarly, we had very low P/D ratios in the late 40s, but they were somewhat high before the Great Depression crash. The number of IPOs in the United States has decreased drastically since around 2000 due to the passage of the Sarbanes-Oxley Act, which drastically increased the regulatory requirements for publicly traded companies. You can see here the IPOs peaked around 779 in the mid-90s, and in recent years, the highest year for IPOs has been around 253 in 2014. So one of the effects of Sarbox is companies are delaying going public much longer. Some smaller publicly traded companies have decided to go private. Other companies may have decided to not go public in the United States and instead go public in places like London. Other possible sources of financing for relatively small companies would just be bank or small business administration loans. Obviously, if you're starting a corner store, you're probably not going to be selling stock. You're going to go to the local bank. And in some cases, you may qualify for a subsidized loan from the government. Small Business Administration loans include the following three types: SBA 7A loans, SBA Express loans, and CDC 504 loans. The primary distinction is the first two types of loans can be used to purchase basically anything for growth, whereas the final type of loan can only be used for the purchase of fixed assets such as real estate or heavy machinery. The loan rates as of the date of this publication are shown here. The loans interest rate for the general loans is not particularly low, and the 8 and 9% range are for higher loans in the 6 or 7% range, and these again are for the general loans. The CDC loans, since they are for fixed assets and there is a security that they can therefore be seized if things don't go well, have lower interest rates. Other sources of funding for smaller organizations have been created by the internet revolution. One of these would be GrowFundMe, which is a crowdfunding platform that allows people to raise money for small business projects, as well as celebrations, accidents, and illnesses. This was reasonably used to raise some money for a friend of mine who had his arms blown off in an air conditioning explosion. Over $5 billion has been raised on the platform for over 2 million individuals so far. You can learn more about it at gofundme.com. Microloans, particularly in developing countries, are also popular. Kiva will allow anyone to make a loan to an enterprise across the globe for as little as $25. You can use this, for example, to fund a fruit stand in a small town in Africa. And again, for more information on this, you can go to kiva.org. For further reading about Regulation D and the issues related to private equity, I recommend this publication by the Cato Institute, Your Money's No Good Here, How Restrictions on Private Securities Offering Harm the Investor. I thank you for watching this video.